Hi everyone, I will be doing chapter 7 of Cost and Management Accounting 1, and the chapter is on the cost volume profit analysis, and I will do this exercise and try to expand and explain other possible ways in which a question can come out of this chapter. And I will be doing 7.3 of the prescribed textbook. Now it says Buffy Limited manufactures and sells a single product. So now they manufacture and they're only selling one product. Buffy invested an amount of 100,000 rands in the business and strive to get a return on investment of 25% annually. So now this is the 100,000 rands that was invested, and the expectation is that the return out of the investment must be 25%. So now that means the return on the investment will be 25% of the amount that has been invested. Meaning now the desired return on the investment, they sometimes call that desired return on the investment. So now the desired return on the investment, meaning the amount that the owner wants to get the return out of the investment or out of what he has invested, it is 25,000 rands. So now the return on investment is 25,000 rands, meaning 25% of what he invested is what he wants to get as the return. Then after it says Buffer does not intend to keep any inventory. So now they don't want to keep any inventory at the end of the period, therefore now there will be no opening inventory. Then it says the following data are available. Then we are given the direct material per unit. Take note, it is 12 rand 50 cents. And we know that direct material, it is a variable cost. Then we are given the total direct labor cost, and take note, it is total direct labor cost. And this total, we also know that it is a variable cost. We need to note what is variable. Then we are given variable manufacturing overheads cost per unit, and they already specify that these overheads are variable, and it is 1 rand 50 cents per unit. Take note. However, when it comes to the total direct labor cost, it was in total. Therefore, now we have to convert it into per unit cost of labor. Then we are given the units that were produced, or units produced 1,000. So now in this case, we need to say 20,000 of the total direct labor cost. We divide this by the number of units that were produced in order for us to get to the total direct labor cost per unit. So now it will be an amount of 20,000 total direct labor cost. We divide this by 1,000 rands, and it will give us 20 rand per unit. So now 20 rand per unit will be the 20 rand per unit of labor cost. Then after we have the total fixed manufacturing overheads, which is 30,000 rands, and the total fixed administration overheads, which is 15,000 rands. So now for this, we don't have to make any changes. We are fine with the totals when it comes to the fixed cost. However, the variable cost, we normally going to make calculations on the per unit cost. Hence, I converted the direct labor to become 20 rand per unit. Then after, we are given commission per unit sold, and that is commission per unit sold. And we know that commission is also a variable cost. Please be mindful of that. Commission is a variable cost, and it varies according to the number of units that were sold. And they say it is 5%. That means our commission will be 5% of the number of will be 5% of the selling price. And we are given our selling price per unit. Therefore, now our commission will be 5% times by the 40 rand. 40 rand being the selling price per unit, because commission is based on the units that were sold, or the selling price. Then we say 40 times by 0.05, which is 5%. Then now this will give us 2 rand. That means our commission will be 2 rand per unit sold. 2 rand per unit sold. It was 40 rand. We timed that by 5, divide that by 100, and it gave us 2 rand. Therefore, now our commission will be 2 rand per unit sold. That means for every item a salesperson sell, then he gets 2 rand for that item. Then now we are required under number 8 to calculate the number of units Buffy Limited should sell in order to achieve the desired. Take note, in order to achieve the desired. Remember, the desired, we are referring to the return, the desired return on the investment. So now in this case, we are calculating what we call BEP, break-even point. This is the break-even point that we are required to calculate. So now there is a formula on how to calculate the break-even point. And also be mindful that we are not just calculating break-even point, but we are calculating break-even point taking into account the desired return on the investment, because there was a return that the owner expects to get out of the 100,000 that he has invested. And that expected return, it is 25,000 rands. So now we always take the return or the expected return into account whenever we calculate the break-even point, or in this case, the break-even point whenever we are provided with the expected return. So now, just the second part of the question that we need to be mindful of is the fact that we are then required to compile the marginal income statement. We are required to compile the marginal income statement. Very important point first is the break-even point. Then we have to do it in the format of the marginal income statement. But I will do the marginal income statement after I have compiled my workings first. So now I want to start with the workings first, where I have to calculate the number of units. Then after I will do the marginal income statement. Then now remember, we are required to calculate the break-even point. And we know that break-even point says fixed cost, which is total fixed cost plus desired return. And now the desired return, in this case, it was provided to us as, or we have calculated it as 25,000. Therefore, now we have to divide this by contribution per unit. We divide this by contribution per unit. So now we first have to do some calculations before we can substitute in this formula. However, with regard to fixed cost, we do have the total of our fixed cost. Our fixed costs were provided to us, and we had two fixed costs, which was total manufacturing fixed cost and total administration fixed cost. So now that was 30,000 and 15,000 rands. And if you add the two, that will give you 45,000 rands as our total fixed cost. It is 30,000 rands plus 15,000 rands. Then this will give us 45,000 rands as our total fixed cost. Then we also know that our desired profit, it is 25,000 rands. And as I said to you, that whenever you calculate break-even point and there's a desired return, you also need to add the desired return. So now we say 25,000 plus the desired return of 25,000 rands. Then now we have to divide by contribution per unit, or marginal contribution per unit. And we still have to do some calculations in order for us to get to the marginal contribution per unit. So now let us calculate our marginal contribution per unit. And to calculate marginal contribution per unit, we first have to say sales minus variable cost. To calculate the marginal contribution, we say sales less variable cost. That will give us marginal contribution. Therefore, now here we'll have the cost per unit. We'll have the per unit. Here we'll have the per unit, where we calculate everything per unit. We were given the selling price per unit as 40 rand. Then now under our variable cost, we had direct material because we know that direct material is a variable cost. Hence, I highlighted that. Our direct material, we know that it is a variable cost, and direct material per unit, it is 12 rand 50 cents already provided to us per unit. Therefore now this will be 12 rand 50 cents. Then we take into account another direct cost, which is direct labor, which is also a variable cost. And our direct labor, we calculated that to be 20 rand, where we said the total direct labor cost of 20,000 rands, and we divided that by the number of units that were produced in order for us to get to the cost of labor per unit, and that gave us 20 rand per unit. Then we have our variable manufacturing overheads, and our variable manufacturing overheads are provided to us, and here they are variable manufacturing overheads. It is 1 rand 50 cents already provided to us per unit. Therefore now we have our variable manufacturing overheads, which is 1 rand 50 cents. Then now remember, I said to you that sales commission or commission is a variable cost. As I said to you that commission is a variable cost. So now we have our commission, which is 5% of the selling price. And the percentage of the commission is normally, and 99% of the times, commission is based on the selling price. So now in this case, they just said commission per unit sold. Remember, when they say per unit sold, it means it is per unit sold. And we sell our units using the selling price of 40 rand, because a unit is being sold at 40 rand. So now for every 40 rand that you sell an item, 5% will be taken as commission, and that 5% will be 2 rand. So now meaning, as I said to you previously, that sales a person will get 5% for every item which it gets to be sold for 40 rand, and that 5% will be 2 rand as a commission, which will be part and parcel of his salary. So now we record commission, therefore now meaning commission will vary with the number of units that are sold. The more the company sells, the more the commission the salesperson will get. But if the company sells less, or if the salesperson sells less, therefore now he'll get less commission. Hence now, as I said to you, that commission is normally connected with the selling price and the number of units that are sold. Hence now our commission will be 5%, which is 2 rand of the selling price of 40 rand. Therefore now our commission will be 2 rand. And we have taken into account all the variable cost. Remember, if there was also packaging cost, or if there was also packaging cost, because packaging cost is also a variable cost, and unless stated otherwise that it is fixed. Therefore now if it is variable, you also have to take into account that packaging cost. And any cost that is variable must be taken into account when we are doing the contribution per unit. Therefore now in this case, we have taken into account all the costs that are variable. Therefore now if we say selling price minus variable cost, this will give us contribution, and this is the contribution that we need to record here in order for us to get the number of units that must be sold for this owner to get the desired return of 25,000 rands. So now let us calculate our total variable cost, which is 12 rand 50 cents plus 20 rand plus 1 rand 50 cents plus 2 rand, and this will give us 36 rand. And 36 rand is what we call variable cost, as it is mentioned that these are variable cost. So now selling price or sales minus variable cost will give us what we call contribution or marginal contribution. So now our contribution per unit or marginal contribution per unit, it is 4 rand. So now this is how you are to calculate the number of units at the break-even point. Therefore now we divide here by 4 rand. Therefore now this will give us the number of units that must be sold in order for this company to reach the break-even point, and the owner get his desired return of 25,000 rands. Therefore now we'll have 45,000 rands, 45,000 rands plus 25,000 rands equals, then we divide by 4, then this will give us 17,500 units. This will give us 17,500 units. Therefore, now it means the company needs to sell 17,500 units in order for the owner to get the desired return of 25,000 rands. Then after, there will be no extra profit. Everything will just be equal after the owner is taken his return of 25,000 rands. So now these are the number of units that has to be calculated, and we normally call this the break-even point. But in this case, we take into account also the return on the investment. So now remember, we were required to compile the marginal income statement. We need not to be ignorant of that. So now when we are doing the marginal income statement, it sales minus variable cost. Then after, we subtract all the fixed cost. So now in the income statement that we are to do, the only part that is short is only to calculate or to take into account the fixed cost. So now this is the further step now where we are required to compile a marginal income statement. If you are required to do this income statement, please do so. So now I will do it the way it was supposed to be done, although I've already done everything. So now in the income statement, after the contribution, we'll have to say less fixed cost. So now this is the calculation of the contribution per unit. And also I can use the same information to do the income statement. Take note of that. So now we say less fixed cost. Then after we less our fixed cost, we have to say we have manufacturing fixed cost. There were two fixed costs, which was total manufacturing fixed cost 30,000 and fixed administration. We have manufacturing and administration overheads. We had manufacturing fixed cost, then we had administration fixed cost, administration, then now we had 30,000 rands. This is per unit. I want to have the column for total so that we do the income statement in the same page. Therefore, now our total fixed cost will be 30,000 rands here, and here it will be 15,000 rands. Please, when you are required to do this income statement, start it from the bottom. We have 30,000 and 15,000, and we know that there is a net profit that the owner wants to get. We have the net profit or the desired profit to say. Let me say desired profit. The owner wants to get the profit of 25,000 rands. Desired profit. So now whenever you are required to do such statement, you must start with the desired profit, because this is what the owner wants to get. So now we have to work things backwards. So now calculating things backwards, we'll have to say total of our fixed cost. First, it is 45,000 rands. Then now from here we say, in order for us to get to the contribution, which is our contribution here, we say required or desired profit plus our fixed cost, and this will give us the total contribution margin. Therefore, now we'll have to say 45,000 rands plus 25,000 rands, and this will give us 70,000 rands. 70,000 rands now will be our contribution margin. It will be our contribution margin in total. Remember, now I am doing this in reverse. However, what I'm doing here is something that I've already done, because 45,000 plus 25,000 is 70,000. So now if we add the two, this gives us 70,000, which we divided the 70,000 by 4 in order for us to get to the number of units that must be sold for the owner to get the expected return of 25,000. So now I am doing the same thing, but in the format of the marginal income statement, starting it from the bottom going up. So now this is exactly what is happening. In this case, we are still calculating the same number of units, which is 17,500. But now we are doing it from the format of the income statement as we were instructed or required to do so. So now that is why you see in this case, I have to say, in order for me to get to the profit, it will definitely be the contribution minus, remember, it will be the contribution minus fixed cost. Therefore, now that will give us the profit for the period or desired profit. But in this case, we are working things backwards in reverse. So now, because we are reversing, therefore now, instead of saying 70 minus 45 is equal to 25, we say 25 because we don't know yet how much the contribution. Therefore, now we say desired profit from the owner plus fixed cost. Therefore, now this will give us the 70,000 of the contribution in total. Then from here, now we say, okay, we don't know how many units must be sold in order for the owner to get his return. Forget the fact that we have already calculated using my own calculations or my own workings. But it is preferred that you do it from the income statement perspective, not to say you'll be penalized, because no one will know how you have calculated this before. However, the importance is to understand the concept behind. Then now in this case, we do have the total of our fixed cost plus the profit. Then I will say how many units should be sold, because now we have to do the income statement where we say 40 times this by the number of units, times this by the number of units, and also multiplying everything by the number of units. But now from the income statement perspective, we don't know the units yet. However, from the calculations, we know that the units is 17,500. But now from the income statement, this is what you do. You say 70,000, divide this by 4, which is contribution per unit. Then now that would give you 17,500 rands. And from here now you can times your selling price by 17.5, the variable cost 17,500, and all your cost by 17.5, by 17.5, by 17.5, and by 17.5. And now from here we can immediately know now how much will be the total in our income statement. Total sales, total variable cost. You don't have to show these workings, this part that I've circled, but you just have to know that you multiply by the number of units that you have calculated. So now, please be mindful. I hope I'm not confusing you. Be mindful of the fact that you can do this calculation separately, where you do workings as I did here. These are just the workings that I've done, which ends here. You can just do the workings and you get to the number of units that need to be sold. Then after, you just do your income statement from the top to the bottom. But please be mindful or be aware that the net profit must be 25,000 rands, which is the desired return on the investment by the owner. So now that is why I start from the bottom, then I go up exactly how the question instructs us to do. So now in this case, we say 40 times this by 17,500, and this gives us 700,000 rands. This gives us 700,000 rands. This is 700,000 rands. Then after, we say our total, which is 36 variable cost, times by 17,500, and this gives us 630,000 rands. Now, if you look at this, before we calculate the total of all other variable cost, if you look at this and you say 700,000 rands, which is our total sales, minus 630,000 rands, do you see this gives us 70,000 rands exactly, which is our contribution. And if we say our contribution less our fixed cost, and our fixed cost is 45,000, this gives us the desired profit of 25,000 rands. So now whenever you are doing a marginal income statement where there is a desired profit, make sure that you calculate it in this manner. So now in this case, we have taken this into account. Then we must do the cost for each cost element. 12 rand 50, which is direct material, times by 17,500. Then this will be a total of 21,000 or 218,750 rands. Then we have 20 rand of the labor, times this by 12 or 17,500, and this gives us 350,000 rands. Then after we have 1 rand 50 cents of the variable overheads, times by 17,500, and this gives us a total of 26,250. 26,250. Then we have our commission of 2 rand, times by 17,500, and this gives us a total of 35,000 rands. And now if you say 35 plus 26,250 plus 350,000 rands plus 218,750, this gives us the same 630,000 rands, just to confirm. Then after, now we say 700,000, as I shown you before, 700,000 rands, which is our total sales, minus 630,000 rands. This gives us 70,000 rands, which is our contribution of 70,000. As you can see, that's 70,000 minus fixed cost of 45,000 rands, and this gives us 25,000 rands. So now this is how you calculate the number of units to be sold in order for the owner to get his desired return, which is the same way on how to calculate the break-even point in units. So now this is the break-even point in units, as I said to you, 17,500 units. Now let me go to the next requirement, very important exercise to take into consideration. So now this was the first requirement, which was requirement number A. Now in this case, in the second requirement, we are then required to determine the number of units. Once again, the number of units. Previously, it was the number of units, and the number of units, it will normally be the break-even point, where you say fixed cost divided by the contribution per unit. Then now we also always, as I said to you, have to take into account the desired return on the investment. The desired return on the investment, which is 25,000, which came from 25% of the amount that was invested. Don't forget that. So now in the second requirement, number B, they say determine the number of units to be sold to achieve the desired return on investment. If Buffy Limited decides to decrease, take note now, there's a decrease, decides to decrease the commission on sales to 3%. So now our commission is going down, and they say such a decrease in commission will have the effect of increasing fixed administration overheads by 10%, meaning now our fixed administration overheads will then decrease by 10%. So now this is the new calculation if there is a change or a decrease in the commission and also an increase in the fixed administration cost. Then now we are still required to calculate now the same, to calculate the number of units if there are these changes. So now remember, whenever you are required to calculate the number of units, it could be break-even point or just the number of units, which in this case the break-even point for the owner to get his profit. In this case, you say fixed cost divided by contribution per unit. It does not change. This is number B. So now this is break-even point. Let me first do the workings. I will do the workings, then after I do the income statement, because also under number B, they require us to compile a marginal income statement. But it's preferable that you can just start doing the calculations, then you calculate the number of units before you do the income statement. However, each one is still correct. So now let us calculate first the break-even point, which is in units, which we know that it is total fixed cost. And our fixed cost, we have to add the desired profit. And the desired profit or the desired return In this case, it is still the same 25,000. Then we divide this by contribution. We divide this by contribution per unit. We divide this by contribution per unit. And now our total fixed costs are expected to change, because we heard that our administration that are fixed will increase by 10%. So now that means our total administration cost of 15,000, we need to say times this by 10%. And if we times this by 10%, it will give us 1,500. Just confirm that 15,000 times by 10%, this will be 1.5. So now we say 1.5 plus 15,000 rands, this will be 16,500. That means now the increased administration fixed will be 16,500. Then I will say 16.5 plus 30,000, because our fixed overheads remain the same. Our fixed manufacturing overheads remained the same. There was no change. Therefore, now we say plus 30,000 rands of the fixed manufacturing overheads. Therefore, now we'll have the new total fixed cost, which in this case will be 46,500. 46,500. The desired return on the investment by the owner still remained the same. There was no adjustment, there was no increase, there was no decrease with regard to this. So now we have to calculate once again our contribution per unit. Don't forget, our contribution per unit. And we know this will be equal, let me just calculate the total for both of these. 46,500 plus 25,000 rands, which I did not do previously. Then this will be 71,500 rands. So now 71,500 will be our total fixed cost added with the desired profit on this investment. Then now we then calculate our contribution per unit. We calculate our contribution per unit, and we know that contribution per unit will start with our sales. Remember, this is also the calculation of the marginal income statement. We are already calculating the marginal income statement. We are already calculating the marginal income statement. Marginal income statement. And our marginal income statement, we know that it starts with sales. Let us have per unit and the total. We have per unit, and we also need to account for the total. Then now we start with our sales. Remember, marginal income statement is sales minus variable cost, not minus cost of sales, please. Minus variable cost. And our variable cost, we know that it is made of the direct material, because direct material is a variable cost. Direct material. And we also know that there has to be a direct labor. Then we also know that there was variable manufacturing overheads. Then we also know that commission is a variable cost, and these are the variable costs that we had. Now we need to take into account the fact that there was an increase in one of the variable costs. There was a change or a decrease in one of the variable costs. And that variable cost, where there was a change, it was a commission. Where they said now, they said to us in the second sentence that if Buffy Limited decides to decrease commission on sales to 3%. So now our commission is decreasing to 3%. Therefore, now our commission is 3%. It's not decreasing by, it's decreasing to 3%. That means it's decreasing by 2%. So now if commission is 3%, then we need to know how much will be the amount of commission now. Therefore, now our commission will be calculated as 5% of 6. Then now the new commission, remember there's a change in commission. Now our commission is 3%. It's no longer 5%. Meaning it will be 3% times by 40 rand. Then we say 3 divided by 100 times by the selling price. And this will be 1 rand 20 cents. Now if you wanted, you could have said a commission decreased by 2%. Therefore, now if it decreases by 2%, then now that will mean it will be 2% divided by 100, or 2 divided by 100 times by 40. That means commission decreased by 80 cents. So now remember, previously commission was 2 rand. Previously commission was 2 rand per unit sold. There we had our commission as 2 rand per unit sold. So now it will decrease by 80 cents. Therefore, it will be 2 rand minus 80 cents, 2 minus 0.8. That will be 1 rand 20 cents. So now it's the same way, even if we calculate it in the way we have calculated, which is our commission is 1 rand 20 cents in this case, which is 3% of the selling price, 1 rand 20 cents, which is 2 rand minus 80 cents, the decrease of 2%. So now our commission, now it went down by 80 cents to 1 rand 20 cents. Therefore, now our commission will be 1 rand 20 cents. Then now we have to record variable cost. This remained the same. There was no change. This remained the same. There was no change. And also our direct material remained the same. There was no change. So now we calculate this total. Our selling price remained the same. Also, there was no change. Remember, this type of questions, there can be changes in the product or in the manufacturing cost. They sometimes will tell you in the assessment that calculate the number of units if the owner increase or if there is an increase in the manufacturing costs, or if there is an increase in the production cost by 10%. Remember, production cost is referring to only the direct material, direct labor, and manufacturing overheads. If the change is only the production cost, therefore now it's only these 3 that will be affected. But in this case, they did not say that our production cost elements will change, but they said only commission will change. Now, if they say if variable cost will increase, therefore it means all these costs will have to increase by a given percentage. But sometimes they will tell you that, okay, material will increase by this percentage, labor by this percentage, maybe commission of its cost with a given percentage. In this case, they don't give us the changes when it comes to the production cost. However, if there was an increase, I want to emphasize this, if there was an increase in the production cost, therefore now in the variable production cost, to be specific, what they normally say, increase in the variable production cost. And these are the production cost, and they are also variable. So now that means you'll only have to increase these 3 because they are variable production cost. And in that case, where the increase is only in the variable production cost, that will mean that commission will not be affected in terms of the increase, because commission is not a variable production cost, but it is a variable cost, but it's not a production cost. So now in this case, all the variable production cost, which is direct material, direct labor, and variable overheads, they remained the same. All the variable production cost, which is direct material, direct labor, and variable manufacturing overheads, they remained the same. If there was an increase, I want to emphasize this, if there was an increase in the variable production cost, therefore now these 3 will have to be adjusted by the given percentage, which is the increase. So now our commission went up, then now, or in fact went down, then now we will get to our contribution. We will get to our contribution per unit. And I'm emphasizing on this because I will not do a video on it, but just be mindful, it's highly possible that it will be there in your assessment, because they normally ask questions from that perspective. Then we know that our variable cost previously, they were 36 rand, and they decreased by 80 cents. If you want to do the way I did it previously, you can just say 36 minus 80 cents, because we know that it's only the commission that decreased by 80 cents. Therefore, now this will give us 35 rand 20 cents. Or else you can still say 12 rand 50 cents, which is direct material plus 20 rand plus 1 rand 50 cents variable overheads plus 1 rand 20 cents of the commission. That gives us 35 rand 20 cents. Therefore, now we say 40 minus 35 rand 40 cents. This gives us 4 rand 80 cents, which is per unit. This is our contribution per unit. And we take the contribution per unit, we divide it to our total cost. We divide it to our fixed cost together with the desired profit of the owner. Then this will be 4 rand 80 cents. Therefore, now the number of units that must be sold in order to get to the desired profit or the desired return on the investment will be 71,500 divided by 4 rand 80 cents. Then this will give us 14,896. We round off to the whole unit, 896 units, meaning this company needs to manufacture and sell this number of units in order for the owner to get to his desired return on the investment, in this case of 25,000 rands, if there was a decrease in the commission by 2% to 3%, and also increase in the fixed cost by 10%, which was fixed administration, that went up to 16.5 by 1.5. So now we have to do the income statement as usual. Remember, marginal income statement is sales less variable cost. Then we get to the contribution. Then you say less fixed cost. Then you say less fixed cost. Then now in this case, our fixed cost is provided to us as manufacturing fixed cost. There was manufacturing fixed cost and there was administration fixed cost. Administration fixed cost. And our 30,000, remember we are under the total column now, don't forget. We are under the total column. Under the total column. Now our administration cost went up to 16,500 and our manufacturing cost remained at 30,000. There was no change with regards to this, and we know that after we subtract the fixed cost, we get to the desired profit. We get to the desired profit, which is the net profit at the end. That is the net profit, or the profit that the owner wants to get. And the net profit of the owner has not changed. It is still 25,000 rands. It is still 25,000 rands. That's the profit that the owner wants to get. And from the profit now, we are going backwards once again. We need to know the contribution in total here. Then we take that contribution in total, we divide it by the number of, we divide that by the 4 rand 80 cents, and that should give us the same number of units, so 14,896. Then I will say once again our total fixed cost, it is 46,500 if my memory still serves me. Okay, it is, yes, 46,500, which is, that is the total fixed cost before we took into account the profit. Then now if we add the profit, because now we are doing things in reverse, it will be profit plus the total fixed cost, and this will give us the total of 71,500 if I'm correct. 46,500 plus 25,000 rands. that will be 71,500 rands. So now if this is the contribution, then how many units must the business sell and manufacture in order for them to reach the target profit of the owner? Therefore, now it will definitely give us the same number of units, which is 71,500 divided by 4 rand 80 cents. Remember, 4 rand 80 cents is the contribution of 4 rand 80 cents that we have there. Therefore, now this will be equals this number of units, 14,896. 14,896. Then we times this by 14,896, 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 times this by 14,896. So now this will give us the total sales and the total of all other costs. 14,896. Let me take all the decimals first. We have 40 rand times this by 14,896. 14,896. This gives us the total of 595,840. Then we have our total variable cost, 35 rand 20 cents, times this by 14,896, and this will be 52,439 rand 20 cents, and we just have cents now, but no problem, it's fine. Then now if we say that minus by 595,840, this gives us 71,500. Therefore now the 80 cents is just the issue of the rounding off. Now let me just take the decimals for the number of units so that everything gets to be perfect. Now let me take all the units, which is 71,500, divide by 4 rand 80 cents, and let me take 3 decimals. Then let me take 3 decimals here just to get to the exact 95.833. Times this by 40, it will be this amount. Then you say minus 52,439, 52,439.20. Let me repeat again, 40 times this by 14,895.833. That will be the sales times by 32. Then minus 524,000, 52,439. This is something not right here. 35.20 times this by 14,896. 524,339. Yes, there's another 3 here. 339.20. 339.20 minus the 40 times by 14,895.833. Then minus 524,339.20. Yeah, the rounding off still goes up to the same decimals, but it's fine. So now we get that's an amount of 595,840 minus 35.20 times by minus 524,339.20, and that gives us 71,500 with just comma 80 cents. That is the issue of decimals. I don't want to go back and just take all the decimals now. Then we do the same calculation. We say 12 rand 50 cents times this by 14,896, and this will give us 186,200. Then we say 20 rand of the direct labor times by 14,896 units, and this gives us 297,920. Then we have 1 rand 50 cents times this by 14,896 units, and this will be 22,344. Then after we have 1 rand 20 cents times this by 14,896, then it gives us 17,875.40. 875.40. So now that will be this will be the totals. Let me just recalculate. 1 rand 20 cents times by 14,896. Yes, that is 20, not 40, because I was wondering why the decimals will be different. That will be 18,875.20. Then now the total will give us the same total of the variable cost, of which that is the variable cost of the total. Now, as I said to you that you'll also have to listen to the instruction in terms of how you must round off. However, the rounding off will not be for penalty in terms of your marks in this case. In such case, worry not about the rounding off. Then now, the important part is the fact that you have to know that in the calculation of the number of units, you need to know the contribution and the contribution in total, and you divide this by the contribution per unit, which I have shown you this first in the calculation of the break-even point, where you say break-even point is your fixed cost plus desired profit. This is not always there. If this is not there, please don't look at where is the profit, desired profit. If the desired profit is not there, or the expected return, sometimes they say this is expected return. So now if you see the word expected return, then you must know that that is the desired profit that must be added to the fixed cost before you divide by the contribution per unit. Now, to emphasize this for the last time, as I said to you that in this exercise we were required to compile the marginal income statement. And in compiling the marginal income statement number B, it was based on the fact that there was a decrease in some of the costs. There was a decrease in the commission to 3%, and there was an increase in the fixed overhead by 10%. As I said to you that there will normally be some increases or decreases of the other components of cost, which is maybe material. It could increase maybe direct labor, maybe variable overheads. But I want to bring your attention to the fact that these three costs, I want to stress this so that you don't struggle when you sit in the exam. These are the production, because some questions they do ask this. These are the production of variable production cost. So now if they can tell you that all the variable production cost increased by 10%, therefore now you'll have to increase all of them by 10% or decrease all of them by 10% if it was a decrease. But in this case, all the variable production costs remained constant. But now, as I said to you that sometimes this can increase maybe by 10%, another one decrease by 2%, another one remain constant. Please do listen to the question and decrease the cost and the way it will be instructed on the question. So now with that, I have emphasized and I've highlighted on the basics important part. And this question, guys, is very popular. They normally will ask you in the first part, and do your break-even point. Second part, they will say there's increase or decrease. Then now you must calculate another break-even point. It's a very important question. Hence, I want to stress on it very much. Thank you.